Hope you're well. Thanks for joining us today to go through some few tips here and there about how you can manage yourself better when you're trading. So I'll be sharing with you a few things that we personally do or how we have been handling most things when we have been trading. We've learned this over a couple of failures, so it's not been a very easy ride to learn some of these things, but some of them are really helpful. So we'll be sharing with you some of the things that you can do to improve on that aspect of your trading, because trading is basically a combination of three skill sets, which are good analysis skills, being able to generate good ideas, understanding risk and money management, and finally managing your mood and managing your emotions when you're trading. So let me put it for full screen to be the whole presentation. Okay, psychology of trading. So like I said before, just before I start again, I do believe trading is basically broken down into three main skill sets. One is coming up with a method that can work in the market. A method needs to have an edge. Two is being able to break down and understand money management and risk management. If you have $1,000, how do you trade? If you have $10,000, how do you trade to ensure you don't blow up your account and you still attain your objective of probably returning 5 to 10% consistently? And finally, the third part is how do you manage yourself when you're trading? How do you manage your emotions? How do you ensure you remain disciplined? What are the general habits you've formed around trading? Do you wait for your system to show you a trade, or you just trade for the thrill? Are you more focused on being right, or are you focused on following your plan? Are you focused on making money, or are you focused on following the system that you've developed? Some of those things are basically driven by how you think about markets, and that's what we're going to go through today. The psychology of trading. So in simple terms, psychology can be defined as the study of the mind and human behavior. So there are basically two things here. The mind first, which is what ultimately controls your behavior, but there's also the behavior which can sometimes control your mind. For example, if you have particular thoughts about behaving in a certain way, but you still avoid doing that. For example, you may find that when you're trading, you're tempted to take trades which are not in your system. So you can avoid that temptation by failing to take that trade. In that case, your behavior will model your mind to think in certain ways, which is waiting for your system to be present. But in the other hand, if you took that trade, if you ended up taking a trade which was outside your system, then your behavior is also forming some thoughts in your mind which will basically interfere with how you're trading. So trading psychology therefore means the study of traders' emotions, biases, and decision-making patterns. And in this field, we are going to primarily focus on understanding how people make decisions under uncertainty and risk. So trading is about those two things, uncertainty and risk. Why uncertainty? Because we don't know at the level of one trade whether we are going to make money or lose money. At the point of seeing a trade, at the point of spotting a trade, you don't know whether that trade is a winner or a loser. You have to execute it to find out whether it's a winner or a loser. And in the process of the trade panning out, whether becoming a winner or a loser, there's the movement up and down, which may make you panic and avoid doing the right thing. So how do you make decisions under uncertainty, which is that, and risk? Risk, why? Because you have some money at risk. If you're trading $10,000, you have at least $100, $200 at risk. That's some real money at risk. So how do you make decisions, or how do people generally make decisions when faced with those two things? Because if you understand how people make decisions and whether how they make decisions works or not, then you can also learn how to make the right decisions in this environment. Once you're able to understand how to make the right decisions in this environment, then it can be easier for us to make money long term. So I'm going to cover why do we study it, why do we spend time. One, it helps us make decisions under uncertainty, risk, and randomness. Two, we're able to understand the psychology of the market. Three, we learn how to manage our emotions in trading. Four, we're able to develop self-awareness, which is a valuable trait in trading. And five, we're able to train ourselves to think like successful traders. So successful traders and traders who consistently lose in the markets have different thinking patterns. So for example, how successful traders handle losses is very different from how losing traders handle losses. For a losing trader, a loss means death to their self-image sometimes. It means losing something that is dear to them. So it really interferes with the process of trading in the right way. Just a minute, I want to admit someone who wants to come in. So someone is coming in. I want to move the screen to this other side for me to admit in the right way. Okay. Okay. Caleb has taken up that side, so I can continue with the rest here. So going back, we need to be able to understand how to make decisions under those environments. Two, we need to understand the psychology of the market. So how are most people thinking? What is the market? The market is composed of me, you, the next trader, the people who are attending this presentation. We are the market. We make up the market, because how we make decisions is ultimately what affects the markets in one way or another. Then we need to develop self-awareness, and we need to train ourselves to think like successful traders. So what are the topics to be covered? Emotions and how to best manage them in trading. Consistency. So consistency is very important when you're trading. If you make 10% consistently and another person makes 40%, 50%, but inconsistently, then in the long run you're better off, because you have a consistent source of income, which is way better than not having a consistent source of income in markets. Habits and patterns. So what are some of the habits you need to develop? Beliefs. How do your beliefs interfere with your profits in trading, with your success in trading? And finally, discipline. So I'll just take you through these 5 topics. If you attend our lessons, we have more, but for today's presentation, I'll just skim those through 5 topics, and then you guys will ask me questions in relation to those topics. So emotions, you can see this guy here. He doesn't look very happy. You can see he's very sad. He's just lost a trade. So he's very sad. So this is like Caleb. He had a gold trade last week, which he never took some profits, and finally he's now giving back some of those profits. So if you look at this guy, imagine yourself. All of us have been through this phase, and we're going to talk about it as we're going through the presentation. So let's start off with what are emotions and why do we even go through them. So emotions can be explained as significant responses to internal and external events. So these are just responses that come about to how we respond to internal and external events. Internal, why? How you think will affect how you feel will affect how you behave. How you behave will in turn affect how you feel, and how you feel will in turn affect how you think. For example, when people are in negative states of mind, they tend to have a feeling of depression, a feeling of not being very energetic, and that in turn will make their energy be in a certain way, and then they'll act and behave in a certain way in the world. For example, they may not want to interact with people socially. That's an example of how emotions are just responses to internal thoughts. Sometimes those things just come out of internal thinking patterns, but sometimes they come from external events. For example, how the market is behaving relative to how you expected it to behave is causing you to be emotional. You've put some money at risk, you attached the money, and now that the market is moving away from where you expected, instead of viewing that as information, you're viewing it as a threat because you're losing money. So you respond emotionally. So that's emotions again. So they're just significant responses to internal and external events. In trading, Forex traders tend to respond to the behavior of the market emotionally. The effect of this in trading is losses, since what feels right is often wrong in trading. So I like paying attention to this last statement which I've said, which is the effect of this is losses, since what feels right is often wrong in trading. Why do I like this statement? What feels right is what you're comfortable doing. That is what will feel right. What you're uncomfortable doing will never feel right. Okay? And when you're trading, what you're comfortable doing is not closing your losses, is taking your profits prematurely. And that is precisely the wrong thing to do in the markets. The right thing to do in the markets is to let your profits ride and cut your losses. And those things are you'll be very uncomfortable doing them. You won't feel very comfortable cutting losses until you train yourself to cut losses. This is not something that will come to you naturally. So what feels right is wrong. You feel you should be in the market when the market is just moving. The what feels right is that. But what is right is for you to wait for your system to be presentable, and then you can take the trade. So for example, people feel comfortable to hold losses and close winners. The right thing to do is the opposite. I'm sure anyone who's attended this and has traded at some particular point will resonate with that statement, and if you think about it, you'll understand that is one of the main reasons why you're not making money consistently. Some of the common emotions that people go through in the markets: fear of missing out, fear of losing money. So this fear mainly arises out of impatience. It's very common among newbies and people who don't have a process. Fear of losing money after a losing streak or an account blow up. This one is not very common when you start off, and that's why when most people start off in trading, it's very easy for them to make money initially because they have not developed the fear that comes with blowing an account or losing. So they don't have any fear taking some risk, and often they'll take some risk in the right way. For example, most people will buy something when it's going up and sell it when it's going down. So they may make money by luck for the first maybe 1, 2, 3, 5 trades. And it's because they have not, once they start losing, they develop this fear and then they do the wrong thing all the time. Because instead of taking the trade when it appears, they wait for confirmation, and before they take the trade, probably it's on the verge of turning. So this one comes with some time. We also have the fear of losing money, fear of being wrong. So for a very long time, you've been programmed to be attached to form your whole self-image on being right. And that's why you struggle to be right in every situation. In the markets, that won't work. Because if you struggle to be right, you'll fight with the markets instead of cutting losses. You're only right by following your plan. You're not right by calling the market direction. You have to change your objectives from calling the market direction to following your plan. Then there's fear of leaving money on the table. Greed and lack of systematic trading will make you fear losing money on the table. And then you may end up not closing your trade and losing some money. We have performance anxiety. This occurs when our attention is digressed from the process of performance and instead we focus on the outcome. So under performance anxiety, most traders make decisions to manage their emotional states rather than their trading capital or trade setup. How does performance anxiety affect our trading? 1. You become unable to execute a trade despite a clear edge. Your system has shown you an edge, but you doubt the system. Why? Because you have fears. You're fearing being wrong. You fear losing money, and that makes you not execute a trade despite a clear edge. Poor decision making, especially trade management. You find yourself you don't have the capability to make the right decisions. If the market is moving to your side, you feel like you should take the profit instead of waiting for your take profit target. Negative self-talk, which manifests in the form of underconfidence. So you start fearing the market and you're not confident about your abilities to consistently extract profits out of the market. Impulsive decision making. So this is where you get after losing a couple of trades. So you just decide now, I'm just taking this trade. I don't care whether I'll make money or I'll lose money. So it's moving up, I'll just take it. You no longer have a plan. Your plan is ditched. You had a plan when you start out, but now after the first 3-4 losses, you no longer have a plan. Now the plan is to make money without following any systematic means of trading. That is also very, very wrong. Then you have, how now can you manage some of these emotions? So those are the common emotions you'll go through due to wins and losses. And these are some of the ways you can sort of manage those emotions, or rather you can think of these emotions in some of these ways. 1, using the positive intention of negative emotions. So in most cases, emotions are responses and they have a message behind them. For example, if you're fearful, there are 2 things that could be wrong with you. 1 is you don't have a plan, you don't have a clear framework of how you're going to manage your trades, or you've not done enough preparation to be trading. So you've just maybe heard about trading from someone, you're not competent enough, and therefore you'll trade from a viewpoint of fear rather than from a viewpoint of confidence, because you have not put in the right amount of time. So this fear should actually be a signal to you that you need to put in the right amount of time into your trading. So in most cases, when you experience a negative emotion such as fear, it means you need to pay attention to understand why we have the fear in the first place. It could be a signal that you're doing something that you're not well qualified to do, or it could mean we're looking at things in the wrong way. Perception. So other than this first one, which is common for most people, especially who are starting out. Now, for people who have developed, it's looking at things in the wrong way. For example, you've put in the right time to develop a trading system. You have a way of position sizing. You have an exit plan. You have your stop loss set in place. You have your take profit set in place. But when the market is fluctuating between, let's say, your entry point and your take profit target, you're fearful that the market will just go and take your stop loss, or maybe it won't get to your target. So you start interfering with the market movements. Instead of viewing trades as a long-run distribution of outcomes, you're focusing particularly on what the market is doing at each moment. It would be better, for example, instead of looking at markets every single minute, to look at them from a session perspective. Let's say you could say, London opened at 1.25 on the pound, and we had a rally to 1 point. So you don't care about what will happen. The next time you'll check markets is towards New York. So you'll say probably towards New York. The whole of London, we've had a consolidation, or we've had some movement from 1.25 to 1.2550. Towards New York, it looks like we're probably going to see a continuation to the upside or a correction. If you get a correction, we're likely to see a correction to these levels. In that way, you're focusing on what the market is doing, not in how much money is at risk or I'm losing. Because most people, that's how they view markets. I had $200, now it's 100. Wow, what is happening here? Instead of just viewing the movement as information, they view it as profits and losses, pain and pleasure, because if you're winning now, you feel like you're a god. If you're losing, you're a sucker. You can never make money at this game. If you think of trading in those ways, it will be almost impossible for you to turn this into a full-time career and even make money. It will just remain a hobby that you'll just partake and lose money all the way. You have to learn to think in these ways. Then you need to develop self-awareness. In trading, you must develop self-awareness. Self-awareness is the holy grail of emotional management. There are two positions you can do this from, either the associated position or the dissociated position. In the associated position, we mean try experiencing the emotion that you're going through. If you're fearful, don't get lost in the fear. Instead, experience the fear. Try to be as present as possible to what is going on within you. But this one is quite hard, honestly, because most times people get lost in their emotions. But the dissociated position is quite better, because this one, it's like you're watching yourself. So you have given yourself the assignment of, I want to watch how I'll behave. For example, that's how I tell myself, I want to watch how I'll behave when I'm trading. Am I just looking for money? Am I following my rules? Is it important for me to pay attention to certain sessions? Like, am I thinking the right ways, or I'm just focused on other things? So you can also do this by studying your mistakes. How? Just create a table. I think this is an exercise that I can give. Just create a table. Have a table that has about 5 columns. For each column, you could write probably you have your trading situation. That's the first column. On the second column, you could have your thoughts, what you're thinking about the trading situation. You could have the feelings, what you feel you should do in the trading situation. You could have your actions, what you actually did in the trading situation. And then you could have your consequence, what actually ended up happening. So that's a very good way to track how your habits and how your thoughts, how your feelings, because you have a pattern that you normally adhere to. Most people have a very specific pattern of how they handle most things in the markets. Then you need to write up a trading plan. So the last session on Monday, Caleb talked about how to draft a perfect trading plan, and it will really help you avoid emotional blunders. Because every morning when we come into the office, every person has the obligation to go through their trading plan, and that's a reminder of how you plan to handle yourself in the markets. We must try and make systematic decisions, and a plan is what helps us make those systematic decisions, because it forces us to follow a particular process in trading. So have a plan and have the discipline to follow that plan, which is something we'll talk about later. Next, I'll talk about consistency. So every trader who's trading is looking for consistent returns. If you can, for example, just make a tiny percentage of 3% consistently per month, and you think of managing an account with $1 million, that's about 3 million shillings every month, about $30,000, and you're just making 3% return per month. In a year, that will tabulate to a return north of 36-35%. If you ask most traders if they've made such percentages, they'll tell you yes, but not consistently in a month. If you find someone who's made that money consistently over a period of 10 months, that's a rich man. So you really need to think about making consistent returns in the market. So consistency can be explained as doing something in a repetitive manner or in the same way. The objective of every trader is to attain consistency in making money. Great wins are not valuable if they are not consistent. And consistency of outcome needs consistency of process. That's one thing that is like ideas in equals ideas out. Consistency of outcome needs consistency of process. We start with the process and the outcome becomes consistent. Why are most people inconsistent? One, most investors fail to attain consistency in the market, and inconsistency results in giving back money made in the markets. I'm sure every person here who's here and has traded at some point you've made money. You've made $200, you've made $300, probably you even made 1,000, 5,000. But at some point you've also given back all that money and more. Why? Why is it so difficult for you to make money over a period of 15 months consistently? Why is it almost impossible for you to consistently save, and you'll extract as tiny as just a percentage per month consistently in the markets? You find that most people, the only thing they can do consistently is lose. So January you lost, February you lost, March you lost, May you lost. Why is that? Why is that pattern there? You lack a systematic decision making process. Today you're trading this system, leo na trade kama Ken, kesho acha nijaribu Caleb. The next time you're trading like Lawi, you're trading which pairs? Today you're trading gold, tomorrow I look at GBP USD, the next day I'm not even trading, I'm now back into cryptos. You'll never make money consistently in this game if that's how you approach the markets. You only need to develop an expertise in 2 or 3 markets, understand how those markets behave in different sessions, different environments, different contexts, know your setup, know your edge, and have the discipline to follow that consistently. If you just look at someone like Warren Buffett is making money when everyone else is losing money during this environment. Why? Because for him, he does well during bad periods in the markets. When everyone was making a lot of money, when there was a boom in cryptocurrencies and a boom in the stock market, Elon, Bezos, all these people had billions of dollars, but now they've lost 60 billion like Elon. Bezos has also lost a couple of billions, but Buffett has made about 4 billion this year. Why? Because he does well during certain environments. And it's very comfortable to say he will underperform when others will overperform during certain environments, but he knows he'll make money consistently. He has the discipline to follow a simple approach which is called value investing. So you must also develop your approach and have the discipline to follow it. But if today you're trading like this, the next day like this, it will be very hard. The next thing is position sizing. Today you're taking 1% risk. Now because you have lost 10%, you're taking now 4% risk. You're trying to recoup your losses very, very fast. Instead of betting on time, you're betting on making your money very, very fast. If you think like a gambler in this game, you'll gamble in the markets, because the markets you can gamble inside and you can trade systematically. It's just a matter of decision making and how you make your decisions. If you make your decisions like a gambler, it will be very, very hard to make money. So what are some of the tips you can follow to make money consistently? 1, develop a consistent trading process. This means having a consistent approach for every trading task. So how do you research your ideas? Like me, I normally take time during the weekend, 3 or 4 hours, and I'll go through research of the different markets I trade. I just trade 5 markets. So I just go through those 5 markets, look at how they're behaving, where they're trading, is my pattern anywhere close? If there's a pattern, has it met all the criteria? If there's a possibility of a pattern forming, then I'll keep watching it. That's how I do my research. Execution, I have a criteria that I follow. Setups need to have the following checklist ticked: A, B, C, D. I also have sessions. I don't like executing trades, for example, like right now. It's almost 8:30. In different environments, I may change again. For example, during the COVID period, markets are moving a lot during New York session. So then I'll probably take trades during this session. But if I'm trading normally and markets don't have the thrill or a big fundamental driver and they're just moving normally, then I want to execute my positions after London has started and towards New York. Before 7, 8, I should be filled in the market. So I don't execute trades at 11:30 or 12 at night, because that's a session is ending and we are now going into Australia. I don't trade any pair that moves heavily during that session. So why will you find me executing trades in those sessions? Exits almost the same. Rarely will I exit trades when we're in those sessions. Most of my trades will probably end in New York or London, because most of the pairs I trade will move during those sessions. So at least I have a process that I follow on a day-to-day basis. I'd challenge you guys to think about the same. Do you have a process that you follow on your day-to-day basis, or on a week-to-week basis, or even on a month-to-month basis? Do you have one? Then focus on trading a few setups, develop an edge. So in this game, most people think it's about the number of times you're in the market, but the real edge is staying out of the markets is more difficult than being in the markets, because staying out is a matter of waiting for things to clearly shape up before you take a trade, but being in the market is a matter of taking mediocre trades which just will always be there, because markets are always moving. If you have one thing that you should pay attention to, is markets are always moving. So if you want your cash to be always moving up and down, keep trying to anticipate every move. It's very hard to call every move in the market, and if you want to understand it's hard, just write down what you think a particular market will do every morning when you wake up, and observe how many times you'll be wrong in a month over how the market should behave on that particular day. But if you can form a particular pattern which you think, if I can trade this pattern, then I can be right 6 times out of 10 because I've tested it and I've seen it, and you just have the patience to wait for that pattern to be presentable, and you do that consistently, you can easily make money consistently. But if you don't even, those of us who don't even have that pattern, we're just lost now. We trade our opinions. I feel like gold is going up today, so I buy it. I think oil will go down because it has rejected this level, so I sell it. You don't have a specific set of criteria that you follow for you to be in a trade. Because if you're trading well, you should be able to boil down your system to a machine. It should be so easy for you to give a computer rules on how to trade like you. You just give it instructions. When you see these things, if this and this happens, then this and this is possible. So trading is just a matter of that. If this happens, then this is the play. For example, if you're in a trade and it's moving to your stop loss, the play is exiting. There's no thinking about it. It's not like you'll think, maybe I'm not wrong. Maybe this market is just, no, it's exit. You just have a clear set of rules. So focus on trading a few setups, develop an edge there, and also a few markets, and write up a trading plan again. A plan will help you do those two things that I've said before, and a bad plan is better than no plan. So at least if you have a plan, you can gauge your performance based on how you follow the plan. But if you don't have a plan, you don't even know when you're doing the right thing and when you're doing the wrong thing. So have a plan. Next, to look at beliefs. So like a computer has an operating system. For example, Apple machines will have OS as the operating system. Windows will be for other machines. For the brain, beliefs are the guiding system. For example, if I was born in a Muslim maybe background, I'd have totally beliefs from where I was born now. So a belief is just a practice thought grounded in lived experience. We don't trade markets, we trade our beliefs about the markets. So for example, a trader who believes in betting against the trend is likely to see only opportunities only in contrarian trading strategies. And beliefs about ourselves, our personality, weaknesses, past, future, are filters that are placed over the lens of how we view our world. So that's a brief introduction into beliefs, how we form them. One, it's by our experiences. So you could try something and probably based on how that thing turns out, you could form some particular belief over how the world works. Inferences and deductions. So this is about probably thinking about something after going through it, and then you infer some things or you deduct some things from probably running some experiments, doing some things, or by accepting what others tell us to be true. For example, if you attend our course and we teach you some things about markets, then you may form a belief about how markets work based on what we told you. If that is true, you could be on the right side, but also sometimes you may be told things which are wrong, and you need to test out. So most of our core beliefs meaning the primary beliefs we have about life, this is probably our general attitude, that's what I'd say, what you think about people and such things, are formed when you're kids, so we don't really, sometimes you have the chance to think about some of them and reform them, but most times we just sleepwalk through life without really switching up some of these beliefs. Like unasikia mtu anasema I was brought up like this, so I'm just like this. You don't even probably think about whether it's the right way. So, but sometimes it's the right way anyway. So as you grow up, we learn different things from society, our parents and peers, and the cultures also will affect our belief systems. So for example, if you're brought up in a particular culture, it will affect you to think in some ways. If you're brought up in another culture, probably you'll have different beliefs. Then you have identity beliefs. So this is who you believe you are as a person or as a trader. So personally, I believe I'm a trader. Why? Because I'm trading. But that's a belief I have about myself. Environmental beliefs. This is about your culture, the people who you're surrounding yourself with. For example, Financial Hub has a culture. Those are a particular set of beliefs over how things should move. Spiritual, are you a Christian, Muslim, Hindu, Buddhist? Those are also beliefs. Trading, are you a trend follower, contrarian? Do you believe in setting stop losses, not setting stop losses? Do you believe risk is the most important? Psychology is the most important? Do you believe following your system is the right way? Guessing where the market is going is the right way? They are all beliefs. You just need to think hard about which beliefs you have and how they're affecting you. So how do beliefs affect our trading? We don't trade markets again, we trade. Sometimes they also go through blow-ups. But there are some beliefs which you hold that are toxic. I like going through them in my lessons for people to, if you have some of these beliefs, please try as much as possible to ditch them, because these beliefs could be leading you to have the wrong experience when you're trading markets. For example, a good day in the market translates to winning, while a losing day is a bad day. That's not true at all. A good day is when you just follow your plan and you observe the rules that you adhere to. Whether you won or lost, what really matters is following your plan in the long run. The second one is productivity is equated to executing many trades. Wrong again. Productivity is doing things like research, looking for setups, backtesting your system. All those will be productive acts in the market. Thinking about some of these things, learning psychology, putting a lot of time into learning these things. That's productive time. Like guys now who are here, you guys have put in a lot of time to learn these things. So this is productivity in your trading career. But if you think about productivity as just being in a trade, then you're setting up yourself to execute very many trades, because you may be thinking, I need to be productive, so I need to take trades. So you end up taking bad trades. Good trading means never losing. Very, very wrong. Most good traders actually have just a hit rate of about 55%, 60, sometimes even as low as 30. So losing is part of the game. You just need to ensure you don't change your system, you don't switch up your rules. Progress in trading means making money. Wrong. Progress in trading is learning, is developing a system, is researching ideas. That's a lot of progress. To generate high returns, we need to take high risks. Very, very wrong. To generate high returns, we need to take asymmetric risks. That means for every dollar you risk, aim to make at least 3. How can you do that? Then you need to look for good risk-reward ratios. You need to look for a system with a positive edge. For example, if you can find a way to be right 65% of the time, it can be easier for you to even take trades with a risk-reward of about 1:1.5. But if you're always wrong, then you need to look for very big risk-reward ratios. But there are some beliefs, again, which if you adopt, they'll really help you have a very wonderful time trading and increase the chances that you'll make money. 1, losses are normal in trading. Get used to them. To generate high returns, you need asymmetric risk-reward ratios. Figure out how you'll do that. A good day in the market is following your plan. Come up with an effective plan and stick to it. Position sizing, also known as risk management, is the holy grail. That's the right way to think about trading risk. So think about those things deeply. And how to change beliefs in trading is just question your beliefs, look into your deep-seated belief systems, and use the cause-effect relationships. So if you can do those two things, and some more, like doing some introspection, using a journal to record the outcomes of your trading patterns, that will really, really help you change your beliefs. Work on your habits, self-sabotage patterns, work on changing your identity beliefs. Those will really, really, really help you improve your performance. Interrupt your thought patterns also, and also affirmations. Do affirmation exercises to form in new beliefs. You can do more research on some of these topics to understand how to do them better. So finally, we have how to develop discipline. This is the last lesson I'll go through, and then I'll open it up to questions. So discipline is freedom. One trait that stands out among successful traders is discipline. It's all about controlling your state of mind, and controlling your behavior starts with controlling your states of mind. For example, if you're drunk, you're likely to behave in certain ways which you're not in control of. So control that state of mind. Don't get drunk, because you won't behave in certain ways if you're sober. So in trading, it's the same way. Don't get drunk on emotions, don't get drunk on wins, don't get drunk on losses. control those things. And some of the reasons for indiscipline, personality factors. In school, for example, I had friends who just basically had a hard time following rules. Most times these people are independent thinkers, so they have a very hard time just following rules. And those things could interfere with your trading. Not accepting losses, that's another dangerous thing that will cause you to be indisciplined in the markets. Taking too much risk. When you have so much in the line, it's hard to follow rules because your fear is what dominates, and lack of a well-defined plan. So if you don't have a plan, then what are you being disciplined in about? So some strategies that you can use to develop discipline, just basic one, self-awareness, know yourself better, use rules. I think rules are very, very important. So you need to use rules. For example, what are your rules? Before you execute a trade, what do you look for? Before you exit a trade, what do you look for? You need to develop clear-cut rules that you'll use in your trading. And then use mental imagery. That means forming an identity of a discipline. So thinking about your highest version of discipline that you can attain. And using anchors is thinking of moments when you've been disciplined before and trying to translate some of those moments into your trading career. Or rather paying attention to being very, very disciplined when you're trading. So with that said, I think I'm done with what I had to share with you guys today. I'll open it up for a couple of questions if you guys have questions. If you guys don't have any questions, then I think we can stop there. That was actually quite long. I thought I'd take a shorter time, but at least I've taken you guys through what I had. So I hope you've learned a thing or two about trading psychology. If you want to learn more and you're interested in learn more, consider enrolling into our courses. We have a product for as little as $100, but if you want our one-on-one mentorship, come to our offices, visit us, we can have a chat, hit us up and we can have a chat about trading. See you guys in the next one. Peace.
Thank you very much for watching Financial Hub's content on YouTube. For more Forex analysis, financial education, podcasts, and exclusive content, be sure to subscribe.